Several variables point to a further spike in cryptocurrency prices, including the easing of monetary policies, the fall in inflation, the change in the difficulty of mining Bitcoin, and the growing confidence in DeFi. In this video, we will discuss the next crypto bull run is 2024. The video will be amazing, so stick to the end. Before starting the video, smash the like button and subscribe to never miss out on our videos. Since its beginnings, decentralized finance, DeFi, has grown enormously, rising by more than 1,200% in total value locked (TVL) in 2021 and surpassing $240 billion in invested assets. Even though DeFi's TVL has decreased to roughly $60 billion since then due to broader macroeconomic factors such as rising inflation, the groundwork has been laid for DeFi to reorganize the foundations of our financial infrastructure when the next market cycle arrives. Historically speaking, the development of a return to a bull market takes place over 4 years. This time, a recovery in 2024 is possible due to the maturation of current monetary policy and easing economic headwinds, which could allow for reduced interest rates and bring funding back into space. This bull market is likely to be driven by 4 factors: the taming of global inflation, renewed confidence in the sustainability of DeFi business models, the migration of at least 50 million crypto holders from the world of centralized exchanges to the world of decentralized applications, and potentially the following change in the difficulty of mining Bitcoin. Everyone is pondering the question of where users and developers should go for chances in the future. Is the following cycle going to replicate the DeFi summer of 2020, but on a larger scale with a more significant number of users? It is no longer possible for founders of startups to rely on magic internet money. Because of this, it is doubtful that the market will return to the levels of confidence that enabled the founders of the DeFi protocol to reward early users with large amounts of protocol-generated tokens, thereby subsidizing annual yields of more than 100% or even 1,000% on invested capital. The process of minting DeFi protocol tokens will be subjected to higher scrutiny, even though these tokens will continue to be helpful in some contexts. Participants in the market will ponder whether or not the protocol can generate sufficient fees to support its treasury and, in the long run, keep or invest more value than it is dispersing to end users in the form of inflation or rewards. Within DeFi, unit economics is an absolute requirement for liquidity providers and market makers to maximize capital utilization efficiency. This indicates that a DeFi network must eventually be able to produce sufficient transaction fees to compensate liquidity providers once it can no longer rely on arbitrary protocol token inflation. To put this another way, a DeFi system must finally be able to generate sufficient funds. Decentralized exchanges, sometimes known as automated market makers, have consistently been at the front of the distributed finance industry. For instance, SushiSwap pioneered protocol-sponsored early adopter prizes and vampire assaults to encourage liquidity providers to switch away from Uniswap as a trading platform. DDX have historically needed to be more efficient with their capital, as they required substantial sums of liquidity from sources of liquidity to power each dollar of daily trading activity in a decentralized manner. Because the fees paid for every dollar of liquidity locked are relatively minimal, liquidity pools rely on tokens issued by the protocol to generate significant compensation for the liquidity providers. We are currently witnessing the creation of DEX that make better use of their available capital, a trend likely to spread to every other DeFi vertical. For instance, Uniswap 3 enables liquidity providers to concentrate their capital so that trading can occur only within particular price ranges. As long as the prices remain within that range, this makes it possible for $1 of liquidity to enable many more dollars worth of daily trading volume. As a result, one can capture more transaction fees per dollar invested in liquidity without relying on protocol-generated token inflation. One such illustration of this is the decentralized derivatives platform known as DYDX. DYDX does not require normal users to commit liquidity in liquidity pools since it uses an order book to match buy and sell orders. Instead, it depends on considerably more efficient professional market makers to act as counterparties to end users. Founders that can create decentralized business models that generate sustainable unit economics for liquidity providers and market makers will be the ones to usher in the next wave of innovation in the decentralized finance space. The startups that someday develop these business models still need to be created. As a direct consequence of this trend, many early-stage Web3 startup accelerators actively search for the next big thing. Founders and projects will need to continue offering various options with varying risk and reward profiles if they want DeFi to continue accelerating its growth among the next generation of Web3 consumers. As the number of interoperable blockchains that provide high throughput and low transaction rates continues to grow, developers are presented with various options to further develop decentralized financial applications and applications that generate yields independently of centralized control. Competition is going to be an essential driver of innovation as Web3 evolves towards a multi-chain future. This will ensure that end customers receive the highest quality products possible. This was all for today. I hope you liked the video. Let us know your thoughts in the comment section below. Stay safe, and we will be right back soon with another video. For more information, subscribe and watch other videos from our channel.